Chancellor Rachel Reeves gave a rather unusual pre-budget speech this week that basically said, brace yourselves, tax rises will be coming. My name is Robin Moore and welcome to this week's episode of Tax Tidbits, where the Chancellor's speech, described as setting the context for the budget, was far from your typical pre-budget event. She declined to rule out breaking Labour's manifesto promise to not raise income tax, VAT or national insurance, instead insisting that she would make the necessary choices, whether or not they are popular. Reeves has promised a budget for growth and fairness aimed at protecting families, public services and bringing down debt. But while the speech covered a lot of ground, critics are arguing that it left businesses and the public none the wiser about what's actually coming. Some in government hope this will be a one-and-done budget, in which the Chancellor will raise taxes now so she doesn't have to keep coming back for more each year, which makes an income tax hike seem increasingly likely. In short, Reeves has ruled out any doubt about tax raises in the budget and is preparing the public for some tough economic truths, whether they like it or not. From February 2026, Companies House is overhauling its fee structure, and it's not all good news for businesses. Key changes include the digital incorporation fee jumping from £50 to £100, the confirmation statement fee rising from £34 to £50, and the voluntary strike-off fee will drop from £33 to £13, so at least there's a tiny silver lining. Companies House has defended the changes as necessary to boost transparency, support the enforcement of the Economic Crime and Corporate Transparency Act, and fund investigations into fraud and misconduct. This all sounds responsible, so long as you're not a one-person startup who will feel the pinch. A potential downside to these increases is that it could scare off new businesses and push more companies to dissolve, which raises questions about how fair this pricing change is and what real impact it will have. A new report warns that the UK could be sliding towards an economic inactivity crisis, with 800,000 more people out of work due to illness or disability than in 2019, costing employers a whopping £85 billion a year. Former John Lewis boss Sir Charlie Mayfield, who is leading a task force to help people return to work, says that the surge is being driven by mental health issues in younger workers and musculoskeletal problems in older employees. Basically, stress and sore joints are quietly wrecking the economy. The state spends £212 billion annually, nearly 70% of income tax, to put that into perspective, on lost output, welfare and NHS pressures. What's worse is that another 600,000 people could leave work by 2030 if nothing changes. The government is responding with a partnership with over 60 companies, including Tesco's, Google UK, Nando's and John Lewis, to improve workplace health, reduce sickness absence and support disabled employment. While new policies like the Employment Rights Bill aim to balance worker protections with incentives for staying in work. The idea is a win-win, good for employers and good for employees, though success will depend on whether businesses actually get the memo. Nearly 200,000 people on benefits could see their energy debts partially or fully cancelled under new plans from Ofgem, aimed at tackling the UK's record-breaking £4.4 billion owed to energy suppliers. The scheme, expected to start early next year, would target those with debts over £100 between April 2022 and March 2024, as long as they chip in something towards repayment or accept help from a debt charity. Up to £500 million could be written off through the scheme, but the cost would be spread across all households through an extra £5 being added to gas and electricity bills. While the move is being welcomed for debt management, there has been some questions about why customers will be footing the bill rather than it coming out of energy companies' fat profits. The incentive isn't a cure-all, but it's a start to ease the pressure on households drowning in energy debt. A BBC investigation has lifted the lid on a Kurdish crime network that's basically running a whole empire of mini-marts, barbershops and car washes across the UK, all while letting migrants and asylum seekers work illegally. Ghost directors put their names on official paperwork for a fee, but they don't actually run these shops. Instead, asylum seekers are running them, with some working for as little as £4 an hour. These shops often sell illegal cigarettes and vapes, with some going as far as hiding illegal stock in secret compartments to dodge trading standards. Undercover reporters found shops operating openly despite enforcement visits, and some shops changed names and paperwork so often that they resembled a revolving door. Financial crime experts warn that the network has all of the hallmarks of organised crime and could be much bigger than the 100 businesses already identified. The scheme is estimated to cost the UK at least £2.2 billion in lost tax revenue, so I think the Home Office has some work to do. Thank you for tuning in to this episode of Tax Tidbits. I hope you have found this video both informative and insightful. Don't forget to like this video and subscribe to our channel for more updates on tax news and tips. See you back here next Thursday.